So this webinar, I'm going to go over why you need to know your numbers, an overview of the reports that we commonly use to record our performances, and make sure that you understand the difference between profit and cash, what the key drivers of business value are, we'll talk about that, how to protect your assets, how to adopt best practice for learning about your numbers. And then we can outline some potential next steps for you to take to make sure that you continue to monitor and understand your numbers. So feel free to take notes if that's helpful for you, and we'll get on onto the information that you're about to learn. So going back to why you need to do this. So knowing your numbers is vital because it allows you to interpret your reports and know if you're on track to achieving the goals that you set at the beginning of the year in your business plan. So here's the 6 top reasons why I believe you need to know your numbers. They tell a story of your business, allowing you to interpret the results of what your efforts are. It's a black and white story. It's not a subjective feeling. It's very objective. And this helps you identify the symptoms versus the root causes. For example, if you notice your profit is going up, then obviously you are managing to efficiently produce a profit and you're pricing correctly. On the other hand, if it's going down, there may be some ineffective pricing, rework, poor purchasing, there might be some wasted stock that's not selling. There could be inefficiencies in the staff. There's all sorts of reasons why gross profit may go down, but knowing it's going down and measuring it is a big part of being successful here. So knowing your numbers will enable you to spot an early warning sign of a potential issue. So if you know that you're expecting about a 30% gross profit and you are experiencing 25, well, you know you've got a problem. If you're not monitoring it, you don't know. Areas of strength and weaknesses are highlighted by your numbers. Your balance sheet going up, you've got more money in the bank, then you know your business value is going to go up. So understanding your financial numbers, as I mentioned in the preamble to this webinar, helps you make better financial decisions about them. And finally, knowledge is a massive amount of potential. If you take action, there's power in the knowledge as well. So, but the more you know about the business, the more you have the potential to make better business decisions and change the way that your business results are showing. So knowing why you do your numbers is really important. Previously in another presentation, I've discussed the James Stockdale paradox. Feel free to Google it and hear Jim Collins speak more about it. It's really true that understanding our numbers will often feel like the brutal facts. If your numbers are going up, that's great, but often your numbers may be staying the same or declining, and that's different from feelings. So our feelings and thoughts about a business are more subjective and can be illusionary. By contrast, the numbers are the facts, but you must face those facts, and then you can have an ability to change and improve what you do not measure. This seminar is not designed to help make you an accountant. You don't need to know how to prepare a set of financial statements or a budget, but you do need to know, as your own business owner, how to interpret your statements and do something about them. And that's what this seminar is designed to help you do. We're going to be reviewing each of these important reports to help you understand what you can learn from them. We'll work through an example and show some key learnings and things to look out for in a report. We're using a fictitious company called Food Company as we do that. So the trading account. The trading account tracks sales and variable costs and gross profit to calculate the return you're achieving before you deduct your fixed overhead costs. It does show you gross profit percentage, so that indicates whether your margins are improving or deteriorating. And most of that is based on pricing and using stock efficiently. Small adjustments to the items in the trading account can have a huge impact on your overall result. So understanding more fully the drivers of your business can help you make decisions that will improve that profit. I'm going to share more details about this in my in-person Planning for Success seminar on February the 12th, but I'm going to demonstrate a little bit more further right now. So this is an example of a food manufacturing company's trading account. As you can see, they've just had sales of just over $1 million. Their cost of sales was $318,000. That gives them a gross surplus from trading of just under $700,000. The direct costs were $450,000. Yep, there it is. So their gross surplus was $287,000, giving them a gross profit percentage of 24%. Now, suppose this client believes that they can make this business earn a higher gross profit than 24%. So they do some extra work with their accountant and work on some new strategies for increasing their sales. And they particularly look in one area, which might be increasing the customer retention rate, or possibly they'd be looking at increasing the transaction value per client. So there's lots of the work we can do there, but let's just say it was resulted, all that work did manage to result in an increase of sales by 10%. That was good. They also worked with their accountant to review their inventory processes and managed to reduce their cost of sales by 5%. They renegotiated their contract with a delivery provider and they managed to get another 5% savings. What is going to happen as a result of all those changes? Well, as you can imagine, it's quite a bit. It's a 35% instead of 24%. So that's made a dramatic difference of $140,000 from one year to the next by doing those changes. It's not reducing staff, but it's just managing efficiencies and working on some how to keep your staff more happy. So understanding this trading account allows you to identify where small improvements can have a big impact. That's a massive impact on profitability from 248 to 389. And I think it is achievable for 80% of businesses if they would be prepared to try some new things and new ways of doing things. But often that's the hardest thing is thinking about change. So we go through that a little bit more in our seminars. Now, the profit and loss, also known as an income statement, shows all your earnings and costs over the whole year. It tracks the overall performance of your business because it includes all the expenses. The costs of being in business are usually found in the profit and loss account. It matches your income and expenses for the period. So we do accruals as accountants and make sure that the expenses for earning income are in the profit and loss statement. It's important to remember that profit is not the same as cash. In the workshops that I run, we do little exercises on this to really help you understand the difference. And I do that in my cash sales seminar as well, webinar. The profit shown in the profit and loss includes non-cash expenses such as depreciation. So that reduces profit, but it's not a cash expense. You have to make sure that the profit has got sufficient at the end of the period to cover things like loan principal repayments and asset purchases, and of course drawings, because if you pay out all of your profit during the year for expenses, you don't have enough to take money back to you as the owner of the business. So your profit and loss provides a framework to benchmark your results. This means you can compare how you're doing this year compared to last year, or compare your business results to other businesses doing the same or similar services or products to you. Businesses are generally valued as a multiplier of your net profit. The higher your net profit, the higher the business value on sale. Another fundamental driver of value to your business. I had a client who sold a business this week, and she was able to get a multiplier of 5 to what her net profit was. So that was really a good result for her. So her business has maintained a steady profit, but to get a 5 was pretty awesome. This is an example of a profit and loss statement using the same fictitious food company that we talked about earlier. We've taken the gross profit surplus from the trading account and listed then all the expenses, followed by the owner's remuneration, what they took out of the business, and calculated a net surplus or loss. And in this case, it's a loss. It's quite a big loss, $113,000. Which makes it hard for the owner to think about spending more money on coaching. However, if they continue doing this, then obviously the business is definitely not sustainable. So let's say that they took a review of their expenses and engaged in some coaching. And I like it when my business clients see accountancy as an investment to improve your business results, rather than a cost that you need to reduce. So it can be a cost if you use accountants as just preparers of tax returns and accounts, but if you're actually engaging in business advice instead of just number crunching, then we can really make a difference in helping you run a better and improved, profitable, cash flow rich business. So that's a good thing to do. What kind of difference can we make? Well, let's say we managed to reduce insurance by 5% and sublet the building or do something in order to reduce the rent. So that was a good outcome as a result of that extra help. And we do that in the cash flow coaching. We go through the expenses quite carefully. So that made a saving. So those small savings have resulted in an overall difference of bringing the business from a loss to a profit situation of $138,000, despite the fact that they almost doubled their account, or they did double their accountancy fees. There's an overall net surplus of 138. You can see most of the increase is in the trading account. So it's the trading account that's a really fun account to work on. All the areas that measure the trading account can make quite a difference. And that's what we enjoy doing in our workshops. Your balance sheet shows also the statement of financial position, or that's what it's called sometimes. In Xero, the report is shown under balance sheet. And it provides a snapshot of what your position's worth at that particular time. So we usually do it 31st of March, from 31st of March to the next 31st of March. And the aim is to increase the net worth of your business. So it means that your assets are increasing faster than your liabilities, which shows that your business is solvent. But also if your liabilities are greater than your assets, it shows that your business is insolvent and you need urgent action to fix that, or you will go out of business. So you can compare your period from last year to this year to determine whether your business's net worth has increased or decreased between the years. And you can track the strength of your business by seeing how much, how much improvement there's been, or whether it's been actually worse. The stronger your balance sheet is, the easier it will be for your business to survive if a downturn happens in the economy. It does help you to calculate a whole lot of ratios, such as debtor days or inventory days. And just the solvency of your business is all measured through the balance sheet. So let's have a look at the real life example, not the real life, the imaginary example here of a balance sheet. So you can see they've got a negative retained earnings because right now the liabilities are worth more than the assets of the business. So technically this company is insolvent. The working capital is negative, as its assets are 138,000 in total of the current assets, and the current liabilities is 162. So it can't pay all of its creditors all at once, although some of this has got shareholders in it. So the shareholders are going to have to continue to put money in to make sure that this business survives. So the business will need some kind of injection of funds, such as the shareholder putting in more money, or perhaps a loan, or potentially selling the business can obviously solve the insolvency issues and giving that problem to somebody else. But you're not going to get much for your business at this point. So my advice would be to keep the business, but to make sure that we turned it around, or there'd be very little way that you could survive for many years on this. So there's a lot of room I can see that needs improvement in this business set of accounts. So over the longer term, the business would be definitely needing to work on this solvency issue and to manage their cash a lot better. Just to show here the debtors, which is highlighted, divided by sales times 365 is showing that most debtors are paying in 26 days. So if they change that and perhaps requested payment sooner and managed to reduce this by 5 days to 21 days, they'd have an additional $13,000 from their bank accounts. That would wipe off the current account. So that's the sort of thing that we can help with, because we can see behind the numbers here. And knowing your numbers means you can do that. You can do this percentage of debtors divided by sales times 365, and you work out how many days it is. And then you can think about debtor strategies. Now, in the last month's seminar that I did, it was on getting paid. And so you can see that webinar on my website, and you can listen to for free the strategies that I've got there for how to reduce your debtor days, including a guide that we can help give you to help chase up debtors. What other things can we do? Oh, we can perhaps make an improvement in how we turn the stock around, and by doing that you manage to reduce your stock days by 5 days. That's going to show an improvement as well. At the moment, the inventory days is 74. So we want to reduce that, so you have less cash tied up in inventory. Then you'd have a cash flow boost of about $7,500 by doing that. So these are all little strategies that you can do depending upon what your business notes are. So an overall business strategy improvement of $20,000 from working on just 2 or 3 areas. The statement of changes in equity shows what happens to the profits. They can be paid out of dividends or kept in the business as retained earnings. It represents the true net worth or value of the company and is a key indicator of the financial health of the business. It does show whether the company is insolvent. As accountants, we have to provide a solvency certificate at the end of the year that the directors have to sign to say that they will support this business if it is insolvent. And that is a legal requirement, because it is legally, directors have a responsibility to make a company liquidate if it is in trading insolvently. It's not you're not allowed in New Zealand to trade insolvently unless you've got the funds to continue to support an insolvent company. Otherwise, you are trading knowing you can't pay your creditors, and that's like fraud. So if a company has more liabilities than assets, it's insolvent, and the funds will need to be paid into the company to keep it supported. And you need to know that's a legal thing, and that's why directors are charged if they continue trading in a company that's insolvent. So in this position, this company has accumulated losses for the last 3 years. That means the company has no retained earnings and is currently, as I said, trading insolvently. There's no money for the shareholders to take out, no money to reinvest in the company to grow it and purchase new assets. The directors must now take action to increase the profitability of the company, or it will be forced in law to close. So the shareholders' current account records all funds introduced to the business by the shareholders. It can be taken out of the business's drawings. It helps you monitor your personal expenditure made from the business. That is something that we have to discuss with our clients. Sometimes we really prefer you to be on wages and then use those wages, which are tax paid already, to run your personal life. If you're constantly dipping into your business to pay for personal things, there's a huge chance at the end of the year, your business won't be able to pay your tax because you've basically drawn it out through the year. It's very easy to draw it out to pay taxes, because if you pay your tax once a year or 3 times a year, they're big amounts and they're in the future. So I encourage clients to have a regular tax savings account, or to pay themselves wages, or just not to use the company bank account as their own bank account. If you need to take some money out of the business and you've got it in there and you are on wages already with the client, with the company, then you can just pay yourself a bonus, put that into your business account, and you know you've already paid the tax on it, so you don't get a business shock. So a shareholder current account ensures that the shareholder knows how much the business owes the shareholder, or how much the shareholder is taken out of the business. So it can be debit or credit depending upon whether you put money into the business to keep it going, or whether you're constantly drawing money out of the business but not paying tax first. So to put a negative current account back into positive, we need profit, because profit, we can declare a shareholder salary and that will credit the balance of the account, or the other thing that will credit the balance of the account is the shareholder just putting more money into the business, perhaps taking out a personal loan. So if your shareholder current account is a negative, it's really important to get advice from your accountant as soon as possible to discuss the best options for you and your business to get that from being overdrawn to being in debit again. The best thing is to always have your current account in debit, so that the business owes you money, not you owe credit. Oh my gosh, I'm getting confused with my debits and credits. The best thing is for the shareholder current account to always be in credit. So the business owes you money, not you owing the business money. That's where you want to be. Sorry for that confusion. Just showing you in a real life example. So we have the shareholder current account at the moment, where the opening balance is 29,000. He's introduced 2. He's taken out 8. So at the moment, the shareholder current account is still in credit of 21,000 that the company owes him. He's taken money out and hasn't replaced it. So it's a good time now, I think, to put it back in. Fixed asset register, also known as depreciation schedule, records the business fixed assets and facilitates the spread of the cost of the assets over their useful life. So right now, there's a pretty good incentive that the Labor government have brought in, that if you buy a fixed asset under 5,000, we don't have to put it in the fixed asset register. We can actually claim it fully in the profit and loss account. So that's a really good incentive, and I'm encouraging many of my clients to buy new tools or purchase a new desk or a new computer this year. All of that helps the economy in New Zealand, which is a good thing, and that's why this has come in. But if you spend more than $5,000, you buy a vehicle, you buy an asset worth more than 5, you must spread it over the lifetime of the assets, and that's all about depreciation. So it's useful when selling a business because it records the value of all the fixed assets in the business as long as they haven't been written off, depending on the age of your business. So this is a fixed asset register. It lists the fixed assets of this company, which has got a van, a car, it's got some office equipment, it's got plant and equipment, so it totals about $500,000 in total. So we always have an opening value, we have the rate of depreciation, how quickly it's depreciated. You'll see that software and computers depreciated 50 to 60%. They're always, they don't have a long life. Other plant can be as low as 10% because you don't expect to replace it for long. And so those depreciation rates are set in law. They're in a guide that's published by the IRD. And we just abide by that when we prepare the accounts. And so that if you had a car of valued at 1761 and you sold it for 4, then there'd be some 4,000 would come in here, and there'd be some gain on the sale, and you'd have to pay that back to the company, and you'd have to also pay GST on it. If on the other hand, which happened to one of my clients this week, they wrote off that car, it just stopped working, they're not going to repair it because it's not worth it. Basically, we'd claim that 761 as a loss. So, you know, going to write it right out of the books. It's no value at all. Happened to one of my cars once, actually. Okay, so, oh, I've just gone ahead of myself a bit. Let's go back. So I've gone to the fixed asset register, and now the difference between profit and cash. It's very common for business owners to get frustrated that their bank account balance does not reflect their profits. And it's essential as a business owner that you understand why a high profit doesn't necessarily result in more cash in your bank account. So a profitable business can go out of business because it's starved of cash. A business running at a loss can survive because it has access to funds from new investors, financiers, or the shareholders. In other words, cash flow in every single business is reality and is really, really important. Profit, GST. Is GST a profit or a cash thing? It's a cash. So I'm just going to slow down here. Loan repayments. Does loan repayments affect cash or profit? Cash, not your profit. So it reduces your cash, doesn't reduce profit. Interest on loans. Is this a profit or a cash expense? Both. You claim it in your profit and loss account, and it definitely goes out of your bank account. We all know that. Asset purchases. Does this affect your cash or does it affect your profit? It actually affects your cash, which is why I recommend if you are buying assets that are going to be lasting in your business for a long time, you should use a loan to help you with that cash withdrawal. Asset sales. This increases your cash into your business, doesn't affect profit. Depreciation. That only affects your profit. So as you can see, even if your business is achieving a healthy profit, there may be no cash in the bank after paying tax, after making loan repayments, buying new assets, all your debtors has increased, all your stocks increased, or you've taken more money out of the business than you realized you had personally. All those things will mean that a lot of profit at the end of the year can still have a low tax balance at the end of the year. And so we go through this in the Business 101 cycle. It's a useful way to demonstrate the difference between cash and profit. Firstly, owners invest money in the business. This money is then used to purchase assets needed to run the business. So in a chocolate making business, the owners might put in $10,000 and they invest in $9,000 of that to purchase chocolate molds and things like that, for example. They then use those chocolate molds and freezers and ovens and commercial kitchen to generate a profit by purchasing stock and manufacturing the chocolate and eventually selling. So they make goods and then they sell it, and that's how you get a return on your money. So your profit at that point, after you've made the chocolate sold, then you have to invest the profit back into the business, partly to keep the business going, like buying more stocks of chocolate, and partly, of course, to reinvest back into the owners. So what drains your profit and what gains your profit? Profit gains are caused through sales growth, and as we mentioned earlier in the webinar, increasing your margins, perhaps by doing work on your managing better efficiencies in your trading account. And the things that drain profit is unchecked overheads or inefficiencies in the business. There's a lot of things that can drain your profit. What drains cash? Well, there's things you can do there. Slow collection of debtors. Increasing in stock and using your cash to increase your stock, which is probably quite a good idea to grow your business. If you're a chocolate making business, you want to be growing different chocolates, and so you're going to spend some of your profit reinvesting in stock. That's a good thing. But too much stock, not selling it enough, is not a good thing. Paying off loans, paying taxes is essential, and potentially by making faster payments to suppliers. You gain cash by collecting your debtors quicker, decreasing your stock, slow paying of your suppliers, or reducing tax if you've made less tax. So those are the things that would help you with cash. You also, of course, take money out for your own use and repay personal loan cycles. So making this spin cycle go faster increases the return that you can take out. So if you're making it go fast and fast, increasing the assets, increasing profit, increasing cash, you can take more out. However, if it's something slowing the spin cycle because you're just not getting enough profit to reinvest back in the business, you won't be able to do the taking owners out, and you have to put all your profit back into the business. It's actually not going to be a business that survives for that long. So the key drivers for business value is important to know. It's a good measure of how well you're doing as a business owner. And part of knowing your numbers is understanding and measuring those drivers of your business value. Some of these drivers will be such things as your monthly sales figure, your monthly sales figures growth, your revenue transaction per client, your sales and your profit. They're going to be different drivers. And part of when I do an annual business plan with a client, we go through what drivers they're going to measure for the next 90 days and then the next year, and work out on a yearly basis how to improve those drivers. I would prefer to do that sort of work with people individually. So to enhance the value of business, you must first develop and implement a clear business plan and document your organizational structure and the roles. We believe in establishing a cloud-based real-time reporting to help you make better decisions, and we use Xero here. Document systems and processes, ensuring your business is running as smoothly as possible. And then reducing reliance on the owners to enhance its value will make it easier for new businesses to take over when the business is sold. And finally, identifying and managing risks that we know about, such as one of them was COVID-19 and earlier this year, that if they can be mitigated, to understand that before it becomes an issue. So I did a lot of risk management with clients earlier in this year, and we're still doing it right now, actually. So we've seen through this webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you won't be able to fund and pay yourself or fund a lifestyle of getting a better home or a better boat, or, you know, buying a batch. So there's a few other things you can do to help protect your assets. And I'll just go through those quickly now. The first thing is to set yourself up in a business to limit your personal liability. Consider who can be the director of your company and which assets are going to be held personally by those directors. Ensure that you have security over any money that you lend out. Considering alternative ownership structures, for example, if you own a building, then that is best separated into a different structure. And so I do a lot of work with structuring with my clients when they come in first. Reviewing terms of trade and other credit policies to make sure that you have reduced risk of losing sales through non-payment of accounts. It happened to one of my clients last year. He lost a massive account because it was went into liquidation. Ensuring your insurances are up to date and that you have sufficient protection if something happens to you, such as a business interruption insurance or person liability. Excuse me. Finally, to do some financial planning to manage your personal wealth outside of the business, such as having rental properties or other investments, so that you've got more than one way that you're earning income over your lifetime. And then planning for the future to make sure that you have up-to-date wills, powers of attorney, and a clear plan for transferring your assets to the next generation. When I'm helping a person start in their business, these are all things that we look at to make sure that when they start, they're going to go in a way that they're going to continue. So how does everything that I've talked about come together as best practice? Well, every business should have an annual business plan and doing it once a year, an annual forecast, and then some kind of ongoing reporting and accountability. This reporting ensures that the numbers you want to achieve in your plan, you're actually measuring it through the year and using an independent coach to hold you accountable to make changes, because sometimes change is difficult. In fact, most of the time change is difficult. So knowing your numbers is just the beginning, because it does allow you to improve them and ultimately achieve your goals for your business. So your next step, where to go from here? So I'm going to suggest you write down 3 things that you think are going to make a difference if you put them into your business and to make a change. What projects could you do in the next year? Could you get a business plan? Could you do a budget? Could you start looking at some KPIs? Do you need to do some work on asset protection? A problem can be seen as an opportunity to create a project. I'm reading a book at the moment called Principles, and he talks about leaning into problems or leaning into those emotions that at first seem overwhelming, and understanding the learning that you take from the problem, that you can then work on a project to fix it. So problems are things that can be fixed, but you need to identify them and use them as an opportunity to create a change. Doing nothing isn't a way to grow your business. So we can help you by doing business planning. We do that, and we have a price of $2,500 over a year, and that can be paid monthly or installments. Cash flow forecasting, that's about $3,000. Coaching is about $300 an hour for hourly, monthly, bi-monthly, quarterly coaching. Management reporting, we'll give you a price on that if you like it. Complimentary meeting to discuss any of this that you've learnt today is free. So I understand that I also run these business workshop trainings, monthly one and a quarterly one, and we charge $195 for the quarterly and $295 for the monthly one. Now, all of those coaching services can be subsidised by asking for help with a regional business partner network, which does help businesses that are trading through a company and are GST registered. So if you're in that situation, then you can get help to get coaching, because the government does want you to succeed and has put some services as advisory services that you can actually claim and get supported for. So if you want to know more about that, then please email me and I will share that information. So if you've got any questions, feel free to write a question in the chat or question and answer service. If there's no further questions. I'll just say thank you for making the time to attend the seminar, a webinar. We appreciate your time. It is valuable, and you've shared an hour with me now. So I hope I've given you some ideas to ponder and some clear next steps for you and your business. Thank you very much for joining me on this webinar. Thank you.